Thank you for joining us for this very important webinar on internal controls over financial reporting. And we'll be looking more at ICFR from the perspective of non-listed public interest entities. And of course, for those public entities that have not adopted, we would also be talking about the implementation process. We have lined up for you today esteemed panelists and speakers from the regulator themselves. And then, of course, we have participants from key sectors within our Nigerian economy, from the consumer business, from energy and resources, and of course, financial services industry. So it's going to be an exciting session with everyone today. Just some few housekeeping rules for the webinar, just so that we can have a very smooth and efficient process. Please use the Q&A button for your questions, and we would get to all the questions and provide appropriate responses. If we are constrained by time from answering any question, be sure that we would get back to you after the webinar with responses to your questions. So that is how the webinar would go today. I have the privilege of inviting a very senior partner within the firm for his opening remarks. I have the person of Joshua Ojo, who is a senior partner within our financial services industry, to give us the opening remark. I hand over to Joshua Ojo.
Thank you very much, Bolanle. Good morning, ladies and gentlemen. I'm delivering this opening remark on behalf of my West Africa Audit and Assurance leader, who is unavoidably absent. He sends his apology. Some other ventures had to take him away from this particular event. However, I'm sure he will join before we come to the close of this program. Dear distinguished guests, esteemed colleagues and friends, I extend a warm welcome and sincere gratitude to you for joining us in this webinar. I'm grateful for your support in this dialogue about the internal control over financial reporting implementation, which is now due for non-listed public interest entities in the coming months of our FY 2024. To help us in explaining the regulatory requirements on the FRC guidance on management reports on the ICFR implementation framework, we have the pleasure of having our esteemed Mr. Adeshola Amo, the representative from the Financial Reporting Council of Nigeria. Please do help to extend a warm welcome to him. In addition, to have a more holistic discussion as part of this plan, of this program, we are honored to have with us several industry experts who have successfully implemented the ICFR in their various organizations and are willing to share with us their various experience from what transpired in the FY 2023 implementation process. Besides, we have various Deloitte practitioners who are on standby, who will assist us and any one of us in clarifying expectations, as well as share their experiences on the implementation journey. As you are aware, listed companies were required to issue their report on the effectiveness of their internal control over financial reporting for the first time in the year ended 31 December 2023. However, from this year, effective 31 December 2024, the same requirements now comes upon our non-listed public interest entities in their FY 2024 audited financial statements, in line with the requirements of the Financial Reporting Council of Nigeria Act Amendment Act 2023. Therefore, As external auditors, we are required to issue a report on the existence, adequacy, and effectiveness of your internal control system that management and those charged with governance have appropriately put in place. This webinar therefore aims to provide us with a better understanding of your responsibility as clients, as entities, as the reporting entities, and clarify our duties as your external auditors regarding the integrated audit process. We will also discuss the importance of the ICFR and how it can enhance your organization's reporting processes, covering the specific requirements of the FRC ICFR implementation framework and addressing pressing and key areas of non-clarity, which have been raised with our various engagement teams before now and in anticipation. So I will encourage you in any area at all that you have concern, that you have some bit of non-clarity, please be open and free to raise those questions as we go into this particular webinar. One key important thing you need to note is that ICFR is designed to protect interest of investors and other key holders by significantly reducing the instances of fraud and other financial crimes due to poor reporting by public interest entities. Regulatory bodies worldwide see ICFR engagements as an opportunity for entities to improve the quality and efficiency of their financial reporting models. It is therefore important as it will help us to improve investors' confidence in the reliability of financial information published by companies. Absolutely, through this webinar, you will be better informed and equipped with more focused knowledge of the ICFR. This will further enhance the implementation of the ICFR framework in your various entities, which is one of the vital objectives of this webinar. We at Deloitte Nigeria look forward to a successful collaboration and further discussions on a successful ICFR framework implementation as you go on in this FY 2024. Of no doubt that this webinar will provide a platform to learn lessons from our esteemed guests, from the successes and the challenges they had in their implementation journey. And of course, best practices and pitfalls that are coming up should avoid in our own journey. I'd like to thank you esteemedly for joining us in this webinar. I believe and we hope that we'll have a stimulating and informative session. Like I said earlier on, please do feel free to ask as many questions as possible that bother you, and you can be assured that you'll get the best of responses. I wish every one of us the best of this event. Thank you very much.
Thank you very much, Jojo. We appreciate that very inspiring remark from you. Thank you also to our West African Audit and Assurance partner, Mike Daldu, for sending in his message to us. We really appreciate that. We would be going straight into filling the pulse of the people that are in the room. We want to launch a poll question. Please respond to the question that you can find on your screen. We want to be able to understand where you are in your ICFR reporting journey, what you have done, what you hope to do, just so that we can help you navigate the journey as we continue the discussion. Please feel free to respond to the poll questions that you can see on the screen, and we would collate the answers and understand where you are currently as an organization or individuals. Keep your responses coming. The poll will close very shortly. Please keep it coming. Okay, so we are about to close the poll. So the poll has closed. Thank you very much for your responses. Thank you for giving us feedback on where you are in your ICFR journey. I can see that a lot of people are attending an ICFR webinar for the very first time. Thank you for joining, and I believe it will be worth your time. A lot of organizations are yet to adopt the framework from the responses that we have. Many organizations have also said they have identified the controls in their organization, but we have many more that have not done any. Would you be engaging? Yes, most people have said they would engage consultants on the journey. Thanks so much for your responses. It helps us to understand how you are approaching your ICFR journey. I would like to introduce to us a very senior partner within Deloitte, Dr. Uwadiae. He is the West African assurance leader for Deloitte, and he's also a board member of Deloitte Africa. Dr. Uwadiae is a skilled professional in IFRS, internal control over financial reporting, and he is one of the key professionals that helped to shape the ICFR guidelines, working alongside the SEC Committee and the Financial Reporting Council of Nigeria to shape the regulation around internal control over financial reporting. Dr. Uwadiae has served in various capacities in the learning and technical faculties of Financial Reporting Council of Nigeria, the Institute of Chartered Accountants of Nigeria, EFCC. He has also served on capacity building and certification committee of the CIBN. And he is also a member of the Nigerian Integrated Reporting Council. He is a member of several institutes, including the Institute of Directors of Nigeria, Corporate Governance Institutes, Global Reporting Initiative, Internal Control Institute, Accountability and Climate Governance Initiative. So Mr. Uwadiae or Dr. Uwadiae would be helping us understand what the Internal Control over Financial Reporting Council is about, how we should go about the journey. It would be helping us navigate that complexity in his presentation. So I would hand over to Dr. Uwadiae for his presentation. You're welcome, sir.
Good morning, everyone. I'm trying to present my screen. Can you see my screen?
Yes.
Okay, thank you.
It's not on presentation mode yet. Please put it on presentation mode.
Hold on. Put it on presentation. Presentation mode.
You're good to go, Dr. Uwadiae.
Okay, thank you. Okay, thank you, everyone. It's a pleasure to speak with you again. I've been speaking on several platforms on internal control over financial reporting. Like Bolanle has said, I've been part of the policy framework around it for the Nigerian environment. Internal control over financial reporting, it's an imperative for our own present operations and economic environment in Nigeria. It's not something that is new globally. It's been there, and it's not also a phenomenon that just happened a few years ago. It's been in our law since 2007 in our Investment and Securities Act, but it wasn't activated until recently. So I'm trying to, okay. Now, going through the overview of our own Investment and Securities Act, like I said, we've had it. You can see the historic trend that happened with SEC. SEC happened to be the first to import this requirement into their own legislation before the Financial Reporting Council. I'll need to go through this background because of those who are joining, who are having this webinar for the first time from the poll. I can see 69% says we are attending for the first time. So you can see that the guideline, related guidelines for ICFR, we have it in, hold on, please, let me see that. I'm just trying to be sure I have the, okay, yes. So, sorry. So the SEC provisions for internal control over financial reporting has these various sections, and these sections actually try to explain what is required for organizations and what is required by different entities. Certification is now being required by entities that are implementing internal control over financial reporting, and also it places duties on directors to ensure that internal control is implemented within the organization. Now, all these sections have also been adopted by the Financial Reporting Council, as you're going to see from the next presentation. Please just give me a few minutes. I think I need to quickly change this slide. Sorry.
Whilst we wait for Dr. Uwadiae for his presentation, I would like to launch another poll to feel the pulse of the people in the room in terms of their expectation from the webinar. Please feel free to respond to the question that you have on the screen so that we can get your feedback on the session. We have more people that have indicated that they are attending this webinar for the very first time. Dr. Juwari, are you?
Yes, I'm back. Sorry.
Okay,
I
thank you very
needed
much.
to
Okay.
just pick the correct slide. Okay, thank you very much. Sorry for that. I needed to pick the right slide. The SEC rules also came up with rules around independence to ensure that entities do not engage their auditors to do what independence would not permit. You would not help your clients to set up the system, and at the same time, you end up auditing the same system. That will be a self-reveal threat. So we are also in the guideline encouraged to focus more on items that are material, and our focus will be on the materiality scope that are being set, and that will be agreed with the auditors. Now, the same guideline asks that we should do some form of evaluation based on our assessments, and when the evaluation is done, then we issue a report. The location of the report is not explicitly stated, but most audit firms do place the reports after the audit report. So, like I said, we have other jurisdictions that also have frameworks that are being implemented, and we are encouraged to ensure that we adopt frameworks that are similar to COSO. COSO is not just the only framework. We have other frameworks that are being used globally. Now, for ICFR, what journey are we supposed to ensure we take through our organization? Most based on our experience and what we've implemented so far, we need to do detailed scoping. You need to do for your organization, identify key controls, design and implement. You do a test of design and implementation of the controls, and also test operating effectiveness of controls before you do the evaluation and report. Now, this is just a sort of top-down risk-based approach that we do adopt. It starts from the first process whereby you try to identify and understand the components of the internal control, identify relevant transactions, flow within your processes. This is quite important. We do this through what we call the walkthrough. So you may have to do some walkthrough checks in your organization. You identify risk of material misstatements around the account processes, and also you evaluate design and implementation, plan the nature and timing and scope of test of operational effectiveness. Then we move into assessing the findings before reporting. These are all that is expected to be done within your organization. Now, what is public companies expected to do? From my experience with listed entities, you need to develop an understanding of the expectation of key stakeholders in the ICFR program. All those that are involved in the governance process will have to be carried along, especially the board, to ensure the top-down approach, ascertain a current state assessment, then you design a roadmap, then you proceed to reporting. Now, this is the framework that is expected to be used, which is the COSO framework. From the COSO framework, it has 5 components. It has 5 components and also 17 principles. These 5 components and 17 principles are expected to be tested for presence and to be sure that they are functioning. The COSO framework itself focuses on operations, financial reporting, and also compliance. But because internal control over financial reporting focuses specifically on financial reporting, so we will be placing more focus on the aspect of the definition that has to do with financial reporting. Now, these are just further explaining the aspect of operation that has to be focused on, ensuring that we prevent losses, timely detection of loss, and also reporting of whatever loss that have been identified in any organization. So with regard to the reporting process, it has to do with external reporting, internal reporting, and also other non-financial objectives are to be reported upon. For laws and regulations, we need to ensure that the adequate laws and regulation have been addressed. Now, like I said, the framework addresses 5 components, and also it has 17 principles. All these must be tested. Now, from our experience with the implementation that we have done so far, which I will now share on that, what are the lessons that we have learned? The first lesson that we learned with regard to this is the fact that management are now taking responsibility for controls. That is the first lesson. Before now, management or the board of directors just see controls as the responsibility of maybe the operating within the organization. The directors themselves don't really own it. But this time around, directors are now owning up to their responsibilities as far as internal controls is concerned. The directors are now being taken through some form of an awareness program to ensure that they understand what the guidelines is and the expectation within the guidelines. Then also, another lesson learned is that most organizations are beginning to take fraud risk assessment seriously. Fraud risk doesn't sit with just the risk management unit anymore. Fraud risk has been taken to every segment of the organization. They are all involved in identifying the fraud risk process. Now, also another lesson we learned is the fact that documentation are lacking. Most organizations do not have well-documented processes or controls within the organization. These are things that they are still fixing. Like we know, whatsoever is not documented does not exist. They tell you, oh, we have this, we do this, but it has to be documented. Now, beyond documentation, we discovered that risk and control matrices do not really match in some organizations. So since listed entities are facing this challenge, non-listed entities, definitely we expect that we'll also find these instances happening within your organization. So it is quite important and imperative that risk and control metrics will have to be refreshed. Beyond refreshing risk and control matrices, this ICFR implementation period is an opportunity to look at policies, procedures, and also the structure of the organization itself. There will be need for structural realignment. While implementation was going on, we discovered in some instances that some units within the organization don't even understand how they relate with other units. For example, how does internal audit and internal control relate as far as certain expectations within ICFR is concerned? Who is responsible for process? Who is responsible to review the process? Most times we discover that there are lapses in interaction between these units in the organization and also the process owners. Do they really understand what is expected of them? At times, you have process documentation, it sits with FinCon, and the Treasury does not even have the full process documentation with them. This ICFR implementation period is also a time to see how do we improve on our control strength. Most organizations have manual controls prevailing within the organization. This is the period to ensure that what we can automate, we need to automate. Automation is imperative as far as ICFR is concerned. So for you as an organization, you need to come up with a roadmap and an approach as to how you address this. Some organizations engage consultants to support in the process, while some organizations decided to do the implementation internally. But what is most preferable is to engage experts in the process and share ideas, because this is the first time that implementation is being done. So there will be need for us to ensure that our organization get it right. We are working with the regulators, and the regulators are also giving us their own expectation as far as entities that they will be reviewing in due course are concerned. So it is a wonderful opportunity for us as an organization to put all our processes in place, ensure that they are well documented, ensure that management understand their expectation to own it, and also the fact that they will have to do a self-assessment, and the self-assessment will now have to be audited by their auditors. And at the end of the day, whatever report that came out will be published. I don't think you want your organization to have a qualified opinion on account of inadequate controls, or you do not also want material weaknesses to be disclosed on your financial statement. So it is important that we take this seriously, and let's put in all that is required, engage those we needed to engage, and ensure that we come up with a very successful implementation. I can tell you for listed entities, we had a successful implementation. Most of the listed entities are now putting in place remediation plan for those areas that we have identified some remediation recommendation for. So I will be ending it here so that when we get to question and answer session or during the panel session, I'll be able to take more questions along with the other panelists. Thank you very much, and sorry for the initial hiccup.
Thank you very much, Dr. Uwadiae, for that insightful presentation. That is a practitioner's view, giving us his experience with the implementation of ICFR for public listed entities, and for some non-public interest entities that have also started their implementation journey. Thank you very much. It is time for us to invite our second keynote speaker. We want to hear directly from the regulator themselves. The Financial Reporting Council has issued its own guideline for the implementation of internal control over financial reporting. And they are the ones that have given us step-by-step guide for public interest entities, other public interest entities that are not regulated by the SEC in terms of what they must do. There is no other better person to do justice to this than Mr. Adeshola Amo. Mr. Adeshola Amo is a director in Financial Reporting Council. He heads the Directorate of Auditing Practice Standards. He is a seasoned professional, a fellow of the Institute of the Chartered Accountants of Nigeria, certified member of the Association of Certified Fraud Examiners, Austin, Texas, USA. He is an associate member of the Institute of Chartered Secretaries and Administration of Nigeria. He has been with the Financial Reporting Council since 2006, and he has risen through the ranks to be a director within the practice. Mr. Amo has with him over 28 years experience in financial reporting, and he has spent 18 years of those developing standards, doing investigative financial analysis, regulatory compliance monitoring, and he has been involved in a lot of practice review for audit firms and corporates within Nigeria. I would like to open the floor and welcome Mr. Adeshola Amo for his presentation. Thank you very much, sir.
Thank you very much. Good morning, everyone, and thank you for having me. Please, can you hear me?
Yes.
Hello, can you hear me? Okay, thank you. I want to thank the management and and staff of Deloitte for the privilege given to me to be part of this webinar. Let me share my screen quickly. Oh, no, sorry, it's not. Okay, just a second. Okay, can you see the screen being shared? Hello?
Not your presentation, sir. Your presentation is not
Oh,
working.
okay. Just what is the problem? And it's open right here in my front.
Mr. Ma, would you want me to share the presentation while you guide me?
Okay, please, you can go ahead. And I did it shortly before the meeting commenced. Okay, please, you can go ahead. Okay, thank you very much. Second, let's go to the next one. The topics I'm asked to handle is the ICFR, the implementation for public interest entities that are non-listed. And if you look at, I think FRC Act section 7.1 and 2F, gave the council the responsibility to demand the report from public interest entities to ensure that they send in their assessment report on internal control over financial reporting, and that such report should be, should include auditors' attestation. The essence of this attestation is to ensure that management don't just write what they think they should write to avoid a lot of cover-up. Let me also say that I like the proactiveness of Deloitte. I remember last year when the SEC guidance was to be implemented, a similar webinar was also done, which I believe helped to sensitize the system to get them prepared. However, we saw some glitches in the implementation, especially among the listed entities, where both SEC and FRC now need to come together to issue a kind of guidelines to ensure that the transition is better put, because we were aware that some entities were not ready. So we want to prevent such, and I hope that other firms both big and medium will be able to do a similar thing. Next slide, please. Next slide. Thank you. Now, what is ICFR? As you can see there, it's a process that is being designed by an organization and to be supervised by principal officers, and it must be effected by top management and directors. I remember when Dr. Uwadiae was giving his presentation, he said one of the lessons learned was that some organizations have started owning it, while some are not. So it's important that it's come from the top. When it comes from the top, you can be sure that the implementation will be better. So the objective of ICFR is to provide reasonable assurance over financial reporting and also the preparation of financial statements for external purpose. So the document, when put together, should ensure that policy and procedure pertain to maintenance of accurate record, provide assurance and transaction being in line with the applicable standards and laws or whatever regulation that is on ground. Then it should also be a reasonable assurance on prevention and detection of fraud. Next slide, please. Next slide. Now, if you look at the guidance that was issued by FRC, it includes the scope. You agree with me that the activities or the operation of FRC is far bigger than that of listed entities. So when SEC issued that of 2021, which became effective 2023, it is believed that there is still a wider operators in the market that should be able to have a robust internal control system over financial reporting to ensure the credibility of the information that will go into the market. You also agree with me that both SEC and FRC, our main objective is to protect investors. So therefore, when the regulation was carved out, which became effective, which will become effective 2024 December, it must include both management report, assessment report, as well as the attestation from the auditor. So it scope out these entities. The small company as defined by CAMA, unit micro bank, insurance broker, non-tertiary education institution, and non-tertiary health industry, including. Now, you agree with me that by the definition of the PIEs, according to FRC Act 2021 as amended, some of these entities are PIEs, but because of their size, they are smaller. So not to burden them. So that's why they were scoped out. However, any organization that desires best practice can go ahead and implement it. So when such organization this listed organization or this sanctioned for not doing it well, time. But if it is done, they want their performance to be tested, to be reviewed by the council. They can on their own send to the council to see whether proper things are done or not. So aside from that, there's no problem. However, all the listed entities that comply with SEC guidance, they've also fulfilled the requirement of FRC Act Section 7, 1, and 2F. Next slide, please. Next slide. Now, everything, or whether law or guidance or standard or rules, they both have pros and cons. So what are the advantages that could be accrued to any organization that do a proper implementation of ICFR? Aside from regulatory requirements, it serves as an early warning signal to prevent and detect fraud and other lawful acts. Ensure that financial records are accurately recorded and presented in the financial statement. Ensure compliance with applicable applicable local legislation, ensure time sets are effective, ensure that errors improve investors' confidence, which is also very key. So these are the things that organizations are going to benefit, things that the system are going to benefit from the implementation of ICFR. Please go on. Next one. Next slide, please. Okay, thank you. Now, if you look at this, this is just in continuation of the benefits that will also be accrued. Now, this classifies into three. When it comes to financial reporting, what benefits? When it comes to operational benefit, what are they? And the regulatory. So this has also been discussed in the last slides. Please go on. Next one, please. Next slide. Thank you. Now, in testing the effectiveness or evaluating the ICFR, the guideline, though not mandatory, but advised, prescribed that COSO seems to be better, or let me use the word better, comply with some of the principles that could be required when both assessing and structuring your ICFR. Other frameworks are also recommended, like, I also presented there rather, but COSO was recommended, not mandatory. So I also remember when Dr. Uwadiae was speaking the other time, he also mentioned it. You have other framework like COBIT, ISO framework, COCO, and so on. So organization can pick whichever one they think is okay for them in line with the kind of structure and control. Next one, please. Next slide. Next slide, please. Hello, can you hear me? All right, thank you. Now, when it comes to ICFR, if you look at the definition, we say it is a process that is being designed and being monitored, being implemented by the management. So what are the responsibilities of the management concerning ICFR? They have the responsibility to design it, and implementation and monitoring it is key. They also have the responsibility to give annual, to assess its effectiveness annually. They also have the responsibility to do a quarterly evaluation of any change that may occur in the system, the company internal control over financial reporting. Don't wait till the end of the year. Don't wait till the 3 months to the time you're going to call the practitioner or the auditor to come and assess it. Do your internal evaluation by yourself. And where you feel or you think that the system is not working or the controls are failing, then you come up to quickly remediate it before the time. So also need to maintain evidential matter, including documentation. Like when Dr. Uwadiae was saying, whatever is not documented does not exist, and that's the way it is. So it's important for management to have proper documentation of their control. Now, provide quarterly reporting stating management responsibility for ICFR. They also provide annual reporting of management assessment of the company. Then keep the audit committee involved in the operation and effectiveness of the control. It's very important. Audit committee plays a significant role in putting the financial statement together. Now, in fact, in some jurisdictions now, the US that I'm aware of, for you to be the chairman of audit committee, you must be a retired auditor, knowing the significant role they play in putting the financial statement together. So the management should communicate to the audit committee whatever lapses, whatever deficiency they observe in the control, and whatever they have put in place to remediate it. Next slide, please. Next slide. Next. Okay, thank you. Now, management also have the responsibility for disclosure. They need to, certify that what they have in the process of monitoring, what they have observed in the process of implementation and monitoring, they need to, disclose their view of the annual report and knowledge of absence of untrue or misstating statement, that they are responsible for the designing of internal control and procedure to determine the reliability of financial statement and financial reporting. So they need to, give such disclosure, and that they have made certain disclosure of to the company's auditors and to the audit committee. So these are the things that management are expected to disclose in the process of certifying, bringing out their report. Now, if you look at that, their assessment of the effectiveness of ICFR as of the end of the year, they also need to come up with the evaluation of the effectiveness of internal control and procedure within 90 days before the end of the year. This is time they're expected to bring in the auditor. Now, or whoever, whether they are doing integrated audit or they engage somebody else to carry out the exercise for them. The objective of this 90 days is to ensure that within 90 days, whatever deficiencies, whatever material weaknesses that is being observed, certain things are put in place. They test it to run it before the end of the period, and they see that those remediation process are working. Because at the end of the period, if at the end of the years, those things that are put in place, when they test run it and they say they are working, they don't need to report any deficiency at the end of the year. Next slide, please. Next slide. Now, this is a process of evaluation. So the management have responsibility to identify and assess the risk that could affect the reliability of financial statement. Then management evaluate whether it has control in place to address those risks, and the control that management identify and document are also that are important to achieve the objective of ICFR. So these are the things that the management needs to do. Next slide, please. Hello, next slide. Next one. This is also part of, next one, please. Now, in reporting or communicating deficiencies, if you look at this slide, it's classified into three. You have material weaknesses or material weakness, you have significant deficiency, you also have control deficiency. Now, when in the process of the evaluation, the management discover that they have material weaknesses, who should they report it to? So what is material weakness? It's a deficiency or combination of deficiencies such that there is a reasonable possibility that a material misstatement or financial statement will not be prevented or detected on a timely basis. So when such happens, who should the management, the issue should be first to the management. That means whoever is in control, whoever is in charge of the assessment should report to the management, audit committee, shareholders, regulators, and auditors. Now, if it is significant deficiency, it should also be, which it means a deficiency or combination of deficiency that is less. So it's a weakness, but it's less than the first one. It's less than the material weakness. So it should be communicated to audit committee. If it is controlled deficiency, control deficiency operation of the control does not allow management of performing their assigned function. So who should that be reported to? It's only to the management. However, if you look at the last that it has assessed as effective, if one or more, in that case, you cannot say your system of internal control over financial reporting is effective. Next slide, please. This is also a continuation of reporting. Now, in reporting consideration, there's a need for the expression of assessment of internal control by management. So management should clearly disclose its assessment on the effectiveness of ICFR. They should also they need not to qualify its assessment by stating that the company ICFR is effective, subject to certain qualification or exceptions. So there's no need for that. So now, when it comes to disclosure of material weakness, you need to disclose the nature on the ICFR, the management's current plan, and what you need to do, to remediate that material weakness. Next slide, please. Next slide. Okay. Now, let's go to the next one because of time. Let's go to the next slide, please. Let's look at the responsibilities of other stakeholders in this ICFR. Next slide, please. Next slide. Okay, thank you. Okay, now let's look at the responsibility of the audit committee. They oversee the management preparation of financial statement and design the operation of the control. So they also ensure the integrity of the entity's financial control and reporting. They have responsibility to review the assessment of financial reporting risk that are identified. Then they also review management's plan response to the identified financial reporting risk. So, because if the management comes up with these are the risks that we envisage, so what are the things they are going to do, or these are the current risk that we identify, expected to come up with a plan. So all this committee have discuss with management control. They also have responsibility to evaluate the quality of management financial. To the hiring of external auditor is their responsibility. Next slide, please. Next slide, please. Hello, can you hear me? Can anybody hear me, please?
Mr. Mo, we can hear you clearly.
Okay, thank you.
Yes. Can you see your screen?
Thank you.
Okay.
Now, we have the role of yes, I can see the responsibility of external auditors. So they need to follow. When Dr. Uwadiae was making his presentation, he gave us that the auditors should top-down risk-based approach that consider the whole financial reporting system, but focus greater attention on the control areas. So they need to obtain an understanding of each component of the company's ICFR, even in the financial statement only audit. So even if it is not integrated audit, so as an auditor, you need to identify those components of ICFR that you need to focus your attention on. Now, perform an independent assessment and provide a written opinion on the company ICFR as of the period end date in the annual audit financial statement as to the existence, adequacy, and effectiveness of, so otherwise, of the internal control system of the PIEs. They also have responsibility when performing an integrated audit to report on the effectiveness of the management ICFR. Then conduct audit procedure. So these are the responsibility that the guidance placed on the auditors. Next slide, please. So management can decide to engage another practitioner to carry out the activity for them, but it's best done with an existing auditor because he has a better understanding. He's been, he's been auditing the organization. He has a better understanding of the business because when you don't understand the business of the entity, it's difficult to come up with any control. Even the management will find difficult by themselves to come up with appropriate control that is needed. So, what are the challenges that we may face in implementing ICFR by the management? I'm glad when Doctor was making his presentation, from the lesson learned, this may not happen again because from the pitfalls that we experienced last year, so some of those things, many things should be put in place now. The experience that the auditors have gained could be leveraged upon by the management of the PIs are not listed. So which will make their own transition faster and shorter and better if they can engage or if they can borrow from the experience. We are not saying, the council is not saying that the auditor should be the one to design and implement or design the process and implement and monitor for the entity. When Doctor was also talking, he's talking about the threat that could, affect the independence of the auditor. So auditor should, guide that jealously. So what are those things that could be challenging, challenging or become challenges rather in the implementation of the guidance? First one is inadequate involvement of senior level management and board oversight. It's very important. So they need to, yes, the management can put this in design together, but the top management need to get the buy-in. They need to be the one to, it's the policy things. So when that thing is designed, when it's passed down, you can be sure that whatever it requires for its implementation, it could require money, it could require resources, both material and human. So they'll be able to support and the implementation will be seamless. The next one is inadequate manpower. I think in our environment, we all have this challenge when a new law or a new guidance or a new standard, for example, when IFRS came on board in Nigeria, a lot of issues, even currently IFRS 17 and some other standards like that. So definitely there could the implementation, but practitioners to guide them on how to put it together. The component. This is often challenging because it deals with the qualitative issues such as corporate culture and ethics. So this component takes time to embed into the company and cannot be implemented in a day. So this is a very big issue. Then late collaboration. Some organizations will wait until the regulator send them letter. Say we are going to sanction you if you do not supply. I mean, if you do not submit or the report. Then we also have the issue of, or we may also have the issue of inadequate documentation. It has been established that it happened when the listed entities were implementing their own. So those are coming on board can also leverage on what those people have done and see that documentation is properly done because it's necessary. Now, if the regulator wakes up one day and said they want to do a kind of review of the implementation of this and decide to choose some entities to go and do on-site, we want to see certain things. If those documentation are on grant, I'm giving a secret because it may come up maybe now or later. So those documentation can help to address some issues, and the regulator will be happy to see them. Now, other things could be poor project and time management. This is very critical. So if the project is not properly now in things like this, you're supposed to do a kind of analysis, gap analysis. So where are we? Where are we going? The gap between where are we and where we are going, how long it is. So how can we bridge the gap? So these are the things that management need to quickly come up. And in doing that, there's no problem that is insurmountable. There's some time or energy or resources who can do it. Next slide, please. Next slide. All right. Now, so what are the regulators' expectations? What are the responsibilities? Now, as the importance of ICFR continue to grow, organizations must ensure that their internal control are effective and comply with regulatory requirements. That is number one requirement. In doing audit practice should ensure that there's a proper scrutiny. Not just they just give you. We've been doing some review of some firms, and some of the things we've been seeing there, sincerely speaking, they are alarming. So management just they give you a paper as an auditor where you're supposed to express professional, judgment and skepticism. They just take the document and, for example, I won't mention the name of the entity or the firm, billions of naira, because an entity has been incurring loss, accumulated loss. They have huge share premium. They use such to wipe off some losses and at the same time pay dividends. Auditor saw it, the management did it. Do they have control? Yes, it could be in place. Was it properly implemented? You can see that it was not properly implemented. So the next one is the issue of legal requirements. It's also very important. Now, submission is also key. When you prepare it and you do not submit to the council or to whether SEC or regulator, it becomes an issue. This year, like I said, SEC and the FRC, they came together, issue a guideline because we don't want to send wrong signal to the market. So, okay, prepare your ICFR report together with auditors attestation, send to SEC, send to CAC. If I tell you the number we receive, you will be shocked. And now we also discovered that some auditors will just send their own the management report sent to us. You are not the company. It shows that they are the one that prepared the report. Because if you are not the one that prepared the report, you shouldn't be the one to send it to regulator. So these are the kind of things that we've been observing or we've been seeing. So, so what are the responsibilities? What is the responsibility of the regulators concerning this? We are putting in place mechanism to monitor it very well. I can assure you that in the next few weeks or days, we're going to roll out some guidance and publications on the kind of strategies that we put together to ensure that these things, they are not just a boilerplate report. Because if you pick 2-3 reports, they are virtually the same. Auditor's opinion, virtually the same. So we want to ensure that we drill it down to entity specific and that certain correct things are done. Next slide, please. I think that's all. Hello. Thank you very much. If there are questions and answers, I will be waiting for it before out of the webinar. Thank you very much.
Thank you very much, Mr. Amal. That was a very wonderful and educative presentation. I'm sure a lot of questions are coming in from participants from your presentation. It has evoked questions and thoughts from the participants. Hopefully, we'll be able to address most of the questions during the panel session, and we will be going straight into the panel session right away. We have lined up esteemed panelists, practitioners, industry players, internal control specialists to respond to most of the questions that you probably have on your mind around the implementation process for ICFR. I would like to introduce the panel. I'll start with our distinguished partner from our Risk Advisory Department. I have in the person of Ibukun Beecroft. Ibukun is a lead partner within our risk advisory practice, and she is responsible for several areas of governance, risk management, internal controls, and internal audits. She has been supporting a number of entities on this journey, and she would be able to provide a practitioner's view on what the implementation process looks like. So let's welcome Ibukun Beecroft to the panel. I would also like to welcome Dayo Adeniyi to the panel. Dayo is a seasoned finance professional with over 15 years experience in finance roles, including governance, risk, compliance, supply chain, and commercial finance within the FMCG. He is a seasoned professional and head of process and control improvement at Nigerian breweries. It would give us perspective from a consumer business angle, all of the questions that are relevant from a consumer business sector in terms of implementation. He has supported the company in the implementation process last year, and he would provide us his own perspective on how to get implementation right. I also have on the panel Aliu Camillo. Aliu Camillo is a Nigerian finance expert. He is the CFO of Eternal PLC, and he has very strong background in financial accounting, internal controls. He supported Eternal in their journey of implementing, and I believe Aliu would be able to provide us practical experience and insight from an energy and resources perspective. I also would like to welcome to the panel Monday Okogo. Monday is the financial controller for FCMB. He has over 26 years of experience in commercial banking, finance, regulatory compliance, risk management, controls. He has supported the bank in various capacity. He has been within the banking industry for years. And I believe that Monday would help us provide very in-depth perspective on the implementation process, as he has also been one of the champions that supported FCMB in their own ICFR journey. We have the full panel on right now, and I would go straight into the panel discussions. Thank you very much, distinguished panelists, for making our time to be here today. I have listened to Dr. Uwadiae, and I've also listened to our regulator, Dr. Amao, on the ICFR implementation. And one key question that has come from our participant is, how do I know that I qualify as a public interest entity? Should this be something I should worry myself about as an organization? Am I included in the scope of ICFR implementation? So Ibukun, I think you are the one to help us do justice to that question. Who are those that are public interest entities?
Thank you, and good morning, everyone. Thank you for joining the webinar. Just like Bolanle has mentioned, and listening to Mr. Omo, he already highlighted entities that are public interest. So why worry? How do you then know that you are a public listed entity? What the Financial Reporting Council has done is that in the 2023 Financial Reporting Council Act, which was amended, what they have done is that they have highlighted categories that an organization will fall under for them to qualify for as PIE. So as a PIE, it is believed that one, you are a private company that has you're an holding company that has a public listed entity. So for example, if I have a holding company and the holding company has a number of listed entities, so that holding entity is qualified as a PIA and should comply with FRC requirement for ICFR. Also, if you are a concession entity, meaning you have a concession you are expected to comply with. Also, if you are a privatized entity in which government retains an interest. So if there's a government interest in your entity, you are also a public interest entity. You are another thing included in the act is that if the entity is engaged in any tier of the government, whether in public works, within and has an annual contract that sums up to ₦1 billion and above, you are expected to, that means you are handling public fund. In that regard, you are classified as a public interest entity. Also, if you have licenses of government to operate in a particular field, you are also classified as a public interest entity. Also, entities that have their annual turnover of 30 billion naira and above. So if you look at your business and you find any of these characteristics, then you qualify as a public listed entity and you are expected to comply with the requirements of internal control over financial reporting as required by FRCN.
Thank you very much, Ibukun, for that very explanatory response. I believe our participants now know where they fall in terms of whether they are in scope of the ICFR implementation. But I think the next question is, yes, if I fall within the scope of ICFR implementation, who is responsible for the process? Should it be the finance team? Should it be the risk management, internal controllers, internal auditor, board? Who is really responsible for the process? I don't know if you can help me with that, Dayo, from your experience with your organization.
Okay. Ultimately, responsibility is going to be with the board and the management because especially they are going to also report on the effectiveness of the process. Yes, some of it will be delegated to process owners, to internal control, to internal audit, but ultimate responsibility lies with the board and the management because they have to own it. They have to give the create that governance environment in the company, especially in terms of the how they create the entity level controls, the culture, how they assign responsibilities. So they have to own it ultimately.
Thank you, Dayo. Speaking about culture, I just wanted to just get to Aliu. For organizations that are just looking at this framework and trying to implement, how can you really establish a strong control environment as an organization? And what role does culture really play? Because if you're used to doing things in a certain way, that may impact the process. So what do you think in terms of corporate culture? How does it play a role? And how can an organization be able to establish a strong control environment?
All right, Bolali, thank you very much. Good morning, everyone. In terms of corporate culture, we all understand that corporate sectors are set of underlying behaviors and beliefs that shape how most organizations operate. And then when you're talking about corporate culture, it's embedded in a lot of activities in the organizational business because, like I said, it gives influence on the behavior of individuals on how they align to the set objective of organization. So it's very, very important to kind of get a very clear policy and then get efforts that shaping the behaviors. But in terms of establishing a strong control environment, for organizations to ensure effective governance and risk management, it's very, very important to put a lot of key components that can shape a well-controlled and risk-free environment. Part of this, I normally start from that and say that from the leadership and the governance angle, the executive management will be started with the overall activities of the company. And then for you to put a strong control in place, there need to be clear definition and clear objectives of what the organization has set for. In addition to that, there needs to be a very strong organizational structure to be put in place, well-structured internal control and internal audit department as well, and then also have an effective risk appetite in terms of risk assessment on a very regular basis. These factors aid organization for them to be able to put effective control in place. And that, bearing in that, and then putting the corporate culture into this perspective, it makes the organization to have a set and clear objective and then have the necessary resources to be able to put the control in place. Thank you.
Thank you very much, Halil. In terms of the framework, so the internal control framework that we can adopt for instance, a first-time adopter of this guideline, what acceptable frameworks can they embrace? And from your own experience, maybe Monday can help with that. From your own experience, what would your perspective be in terms of the framework that organizations should use for their control implementation?
Thank you, Walali, and good morning to all. From the disclosure from the FRC, they didn't really specify or make it mandatory the kind of framework you should adopt, but they strongly advise and recommend that COSO should be the right framework to adopt because that seems to be more encompassive. It covers many areas that is being required in that regard to have control over financial reporting. So they strongly advise, and going through experience where we have done with our own, that was actually help us when we come using that kind of framework in implementing it. And that helped us a lot. Many things that are being done before that were not documented. You just know it's being done, but it's not documented. With that COSO framework, identify some principal risk. We were able to use it to carry out with the implementation of the internal control over financial reporting. So strongly advised, just as the regulator to have advised, COSO is the right framework to adopt. Thank you.
Thank you, Monday. I think the other part of the discussion would be, I know Mr. Mo had mentioned something around management assessment. So maybe I'll just ask Ibukun this question. Will the management of an entity require maybe a consultant to perform this assessment annually, or can they use their internal resource to perform it? What would be your thoughts around that?
Yeah, thank you, Bolanle, and that's a very good question. I've seen a lot of people ask me, should a consultant do it for them, or can management do it? I'll answer it in two ways. One is if the organization has a strong internal control function or a matured internal control environment where over the years they have put together a risk and control matrix of what their key risk and key financial risks and non-key financial risks has been identified. They've gone through a thorough risk assessment process where they've identified key processes and they have a process around monitoring it. Is something they might be able to do. But experience has shown that most organizations within our client, they do not have that mature environment except if they have affiliate or relationship with multinationals. So in that instance, they will require a consultant who will help to put together a framework that will allow them to have a process around their money or around the implementation of internal control financial reporting. And how would they be able to do it? One, because it is expected that when you're going to look at the COSO framework, you're looking at the 5 components. What are the established procedures that management has put in place? If those are not clearly defined, obviously you will need consultants like ourselves to support you in this regard. If you do not have a risk register, or you've not done your risk assessment or identify what your significant financial risks are, you obviously need you also obviously need a consultant to help you. Also, if you've not been able to assess what are your likely material misstatements, you will need the support of a consultant to help you, or except you then, and there are two approaches to it. If you are not able to get a consultant to help you, there is a possibility for you to hire people who are experienced or do like a collaboration or co-sourcing nature of work for them to support you, so that one is not just for the consultant to do it once for that year and that is it. It is a continuous exercise, and in that case, there's a need to build capacity. So in a nutshell, it's important to understand what is your current state of your financial controls or your control environment as a business. Is it strong enough? Do you have a strong or combined assurance function that is reliable, that you can beat your chest about, like your internal audit function, your internal control function, and your risk management? If those are not present, obviously you need a consultant to help you put all of those in place. And lastly, the consultant will be of benefit to you because they've seen it in different businesses, industries, and they will help you to set the framework and the foundation. Once you get the foundation right, you are in a better position to build on that foundation to continue to perform the assessment. Like you will rightly hear from each of the speakers that spoken earlier, one of the things is they want to boost the stakeholders' trust in the numbers, in the financial reporting that is being put out by management. They want the investors, the shareholders to do it. And they don't want it as a one-off or a checklist assessment. They want it to be a culture that at every given point in time, whatever controls management has put in place, they are appropriately designed and they are operating effectively throughout the financial year. Thank you.
Thank you so much, Ibukun. What I hear you say is that learn from those that have gone ahead of you, and then once you develop capacity internally, you can then take it on yourself. And I think that's just a very good approach. I wanted to just get back to Dr. Uwadiae because I have lots of questions from our participants around the role of the auditor. So a few persons have asked the question, can our auditors do this for us? Can they not? What is allowed? What is not allowed? Dr. Uwadiae, please, would you be able to clarify or help our participants to respond to that question?
Okay, thank you very much. The guideline, the SEC guideline and the FRC guideline has a paragraph on independence. And the paragraph on independence is clear as to the role the auditor can play. The auditor can only come in to review management self-assessment. Management self-assessment has to be done by management and management alone. The auditor cannot support the management in doing the self-assessment and come back again to review the same self-assessment. That will create self-review threat. Also, the auditor cannot participate in design and implementation of internal control for a client that they will still go back to audit. This again is a self-review threat. So it's quite clear in the guideline. The external auditor will only come in to review what management has done. But the external auditor is not part of the design, is not part of the self-assessment process.
Okay, thank you, Dr. Uwadiae, for clarifying that. But I wanted to also get a view. When we say the control activities that needs to be in place, it needs to be documented and all of those. For the sake of those that are listening and it's their first time trying to implement, what type of control activities are we talking about for an ICFR implementation process? And how can organizations ensure that at this implementation phase, they are able to design and implement controls that are effective or meet the objective of the ICFR implementation process? Maybe I should ask Dayo that question because you have gone ahead with the implementation. Dayo?
Hello. So let me start this way because the speakers have actually given a background to this on the steps you have to take in implementation. But if I really dovetail on the controls, because you first have to identify based on a risk assessment, you have to identify the high risk controls that are relevant depending on the industry you are in. Because let me give you a basic example. In my kind of industry now, for instance, you have to first identify in 3 different buckets. 1, risk related to segregation of duties. Then you also have to define risk related to process controls itself, as in the process controls that can impact on the financial reporting in the different areas. When you've identified those risks, they have to be done based on a risk assessment. And that risk assessment will determine what the risks are. Are the risk and the documented and the controls properly documented so that you have a matrix that addresses this risk in terms of what is supposed to be done. And that's the design phase that is supposed to be done with management. So, and when you do that, you will determine which ones are of sufficiently high risk that can impact on the financial statement, can lead to maybe a material misstatement, because those are the ones that primarily you would focus on. So that's it's actually a more detailed process than this, but I'm trying to capture it in
absolutely. I know. I sorry that I had to ask you that question because I know it's something that takes a long time to do, and I'm asking you to respond to me in just 2 minutes. But you have done a very good job of at least helping us understand how to start the process. You mentioned it when you were responding the importance of identifying the risk in the process, the risk within your financial reporting process. And maybe I would ask Aliu to support in that response just before we nail or we move away from that discussion. What factors would you consider in assessing the risk to your financial reporting? What factors are the most relevant that you would consider? You're muted, Aliu.
Oh, apologies for that. Thank you very much, Bolanle. When you are assessing risk, especially in terms of risk over financial reporting, there are various factors that needs to be considered. And one of the very good factor is the test of effectiveness of the internal control. You want to ensure that your design and the effectiveness of the existing control are very, very appropriate. A weak control or where the control is not adequate can lead to a kind of fraud, and you can have a lot of financial mistakes from that. In addition to that, another key factor that needs to be taken into consideration is the nature of transactions. In terms of the complexity and the frequency, or peradventure, the judgment or estimate that goes into transaction. I will give you an example. Looking at Nigeria situations now, in terms of foreign exchange transactions, it requires a lot of judgment and estimate for you to keep a monthly or a quarterly foreign exchange revaluation. So those kind of things go in a long way in determining the assessing the risk that will affect your internal control. In addition to that, you also have something, another factor that we call a compliance risk. You want to ensure that you're abreast of the various developments in the regulation and then ensure that you are compliant in order to avoid any forms of penalty that can affect your financial report as well. One of the other factors that we can look at, you want to also ensure that you are very abreast with the economic factors in terms of market volatility or changes in your industry. because these are the factors that key into most of your judgments or estimates that you use for your day-to-day activities of the business. And then also another key factor, you want to ensure that your financial statement area are well appropriately mapped in terms of where are the areas that needs a lot of focus, where are the areas that have a lot of transactions, and where are the areas where you can have some kind of inherent risk. For example, revenue recognition, revenue cutoff, in terms of activity from our hand here has been a very key factors that we look into when you are determining your material, your scoping and your materiality, and they want to ensure the control in that aspect are very key, and then the risks are well defined and are well identified and mapped accordingly. There are various other factors. I'm just trying to put
I know.
together and see. But one thing that is very, very important, you can identify these factors, but you want to now ensure that what other way do I need to do to prioritize this risk? What do I need to do? How would I prioritize? Which of the risks will I go first? Which of the risks will I profile, or how would I profile? And then I'll try to take you the necessary steps that are needed for you to prioritize those risks accordingly. One of the key steps is that you want to assess the impact and the likelihood of those risks. You want to make sure that you are prioritizing the risks that have a high impact and an high likelihood first before any other risk. Another angle you want to do, you want to have an holistic, something we call a risk mapping. What we have done in our area, we have a list of the risk, and then we did a mapping so that we can see at a glance what are the severity and likelihood of different risks, which one are we prioritizing and which one are we taking next. And another thing that also helps us in implementation of our hand is that we look at the historical information. Where are the trends? Where are the recurring issues? And we want to ensure we prioritize those ones when we are determining our risk assessment. And also, like I mentioned earlier on, assessing the effectiveness of internal control play a vital role in prioritizing your risk. You want to ensure areas where you have less control. You want to ensure that you prioritize them when you're profiling your risk assessment for that. So
I know you will go on and on if I let you, because you're excited about the subject. But I think you've mentioned very key things that I think our participants will take home. The fact that you have to look at areas of judgment, areas of estimates, complex areas, large volume. So that would take me to asking Monday from the banking industry, because they are dealing with complex transactions, sensitive volume. How do you go about this? What's the role of data analytics? Were you able to leverage data analytics to help you identify and address some of the risk in your financial reporting process?
Yes. Thank you, Bolale, for this. Yeah, data analysis play a critical role in that regard in identifying and addressing risk in internal control over financial reporting, particularly have some transaction texting where the data requires NMOX, and due to that large data set to identify unusual or suspicious transactions, such as those exceeding certain thresholds or falling outside normal patterns. The data analysis helps us to streamline this and get us in a good perspective to it. Also, it helps in the area of control monitoring. We use data analysis to continue to monitor control effectiveness, identify potential control gaps or weakness in that aspect. It also helps us in the area of risk assessment. We analyze the data to identify high-risk areas, such as accounts with high transaction volume or complexity in accounting treatment. Or a predictive analysis, we use data analysis to check that, to use some statistical model to predict potential control or failure or risk, or enable a proactive remediation action on that area. Also, automation or reconciliation of some things, we use data analysis to streamline that. It helps us in area to identify area to automate as we go forward in this process. Since the process of internal control over financial reporting is an ongoing exercise. Each year you assess the area that are because of the changing landscape, you also need to update, and you need data, analyzing this data to help you to mitigate all those areas. So data analysis is very, very key in this area. It helps us to narrow down some area that we may not cover manually. I can go on, but
yeah, I know. I know you can go on and on and on this. But some of the procedures that you have mentioned, I'm just looking at it from an auditor's perspective. That's almost what an auditor would do when they want to audit the process. So, Ibukun, from your perspective, how is the ICFR procedure? How is it different from what you would do for a financial statement audit?
Right, very good question, Bolanle. And if we have all been following the conversations that we've had, it is very clear that, yes, there is a clear difference in terms of what you would do as the external auditor and what you would do for your financial statement review and what you do for internal control over financial reporting. One of the things that is different is that one, as the external auditor, it's expected that at your planning phase, you also perform a detailed control review, the design and control effectiveness. But with the requirement for internal control over financial reporting, there is this painstaking detail that you need to go through, and that is for you as an external auditor to look at what management has put in place. And for that to happen, you also want to do a detailed testing, and the testing could be in the form of testing what management has done, or doing an independent testing, which also corroborates what you will need for your control environment testing for your financial audits, as it were, and also for you to look at the testing across throughout the period in which you're reporting on. And why is it really different? Because now, as an external auditor, you need to issue an additional opinion. You need to opine on the internal control over financial reporting for any organization that is classified as a PIA. So it is a more detailed work compared to what you ordinarily do. Yes, you do your numbers, you do your substantive testing of the numbers, you focus on it, and you use your analytics to derive it. Once you've done a walkthrough, you confirm that through a walkthrough that is being done. But that's no longer it's no longer enough now. You then need to look at how the activities are passed over the years, depending on the frequency of the activities. Is a monthly, quarterly, annually, biannually, or the nature of those transactions. So, and those has to be documented, because for you to reach a conclusion, you also need to document it. And as external auditors, what the external auditor is expected to do is to obtain what management have done. If management have not done that at all, the external auditors may have to use their own understanding of ICFR and perform their tests to be able to issue a position. So I hope that is clear that yes, it looks like it's not different, but I can tell you there is a detailed effort that is required for the external auditor to be able to conclude on internal control over financial reporting. Thank you.
Spot on, Ibukun, spot on. Thank you so much. And then I just look at the process itself. For me, it looks like technology would play a key part, at least from an organization perspective, to help you streamline and also automate and make sure that there's some efficiency and controls within the process that cannot easily be breached. But I guess I don't have all the answers to that. I would like to maybe ask Dayo. You are representing a very mature organization with, at least we would say, very controlled processes and advanced in the way you manage your processes and control. What do you think the role of technology is, and does automation help? What are the risks? Are there benefits from automation?
Thank you for that. But there are very big benefits of automation. So, but I'll look at technology on two different tracks. Technology in terms of reducing risks. So, because if you look at technology in terms of reducing risk, especially a lot of things like manual journal entries and everything, in the coming of robotics has reduced risk in that kind of area. And this is something that as an organization, we're doing a lot of to reduce the risks of errors, risk of fraud through manual journal entry. But technology also comes on another track as well, which is also in terms of the implementation of ICFR. Because implementing ICFR, it can be very time consuming and complex. So you now need, when you implement workflows, technology like ServiceNow that helps you keep track of the deficiencies so that you can also keep track of how you mitigate the deficiencies, help keep the management honest. What I mean by management honest, ensure that they keep their align their responsibility with the task so that they can also be held responsible for the remediation of the task. And technology helps you that because you have all these tools like ServiceNow and code that can help you do that. Because without that technology, let me give you a simple scenario. Regulations change very rapidly. And as regulations change rapidly, you have to change the scoping of your controls. You have to change the design of your controls. So if you don't have those technology that helps you in the administration of even ICFR itself, it's going to be very complex, especially for small organizations. I know small organizations will be thinking, should they invest in this technology and everything? I'm sure consultants will help them with that decision. But from our own experience, the technology has helped us because that's why we're able to do ICFR we have an interim, we have the first interim assessment, we have the final assessment, because I remember Mr. Amao said you must, the 90-day window, and that 90-day window is very useful for remediation, so you don't have such deficiency that end yet. But so if you don't have those technology, it's difficult to do that within that 90-day window, for instance. But going back to the first pillar that I mentioned, which is actually reducing risk using technology in terms of ensuring that, look, you have segregation of duties and you limit critical access to only people that actually need it, or you in posting of manual journal, which is a high fraud risk area, for instance, you can limit that risk. So there's just a lot of different things that technically can do based on those two pillars.
Okay. Thank you very much. I'll just quickly have Mr. Amao respond to one or two questions from our participants. The first is, when is this due? When should we start our implementation journey? And secondly is, are there penalties if we do not get this right when we are supposed to get it right? Just your perspective, sir, from a regulatory angle.
So, sorry, the question again.
So the question is, when
Please, the question again.
The question is, Mr. Mo, when are we to implement? Is it this year? Is it next year? And the second question is, if we do not get it right, are there penalties for not getting it right or not even implementing at all?
Not doing it at all, there could be sanction. When we are not implementing it right, there could be correction. But as far as the guidance is concerned, it's effective 2024. So meaning by 2025, when the FS will be released, it should include both management assessment and the auditor's attestation. However, there could be some consideration if an entity feels it could not meet certain things on one-on-one basis. It could write to the council, and if the request or the situation there it could be acceptable, then maybe a waiver can be given. A case in point is an entity that is they are doing merger, they are merging, and in the process, they were not PIE before, but the margin will move them to be PIE, and they are expected to have carried out the 2023 SEC guidance. So they wrote to the council. So based on the situation, we were able to. So it could happen, but not implementing it at all, there will be sanction. But if you implement it and you don't implement it correctly, there could be correction. There could be
Okay.
correction.
Thank you very much, sir. I think that would help to clear the minds of our participants on the implications of not moving fast on this. I guess looking at the complexity that we have painted in terms of how to start the journey, what you need to do, the role of automation and all of that, I would lean on Monday, because I know banking, you have complex transactions, you have volume and all of that. What do you think are the most common challenges that an organization can face in implementing and maintaining an effective ICFR process?
Okay, thank you, Bolande, again for the question. Most of the challenge of complexity in implementing the internal control over financial reporting could be as well lack of resource and budget, insufficient resources in terms of personnel, technology, and budget can hinder effective internal control, financial reporting, maintenance, or implementation. So the resource should be enough to handle that in terms of person and technology, and a little budget depending on the organization to help to implement that. Also, inadequate training and awareness. Just as you have taken the poll this morning, some fraction of the participants were not fully aware of this. So where they are not training, either in the organization with respect to this implementation, it may have some challenges in executing it, or the awareness is not well spread out around the organization. You may have some not well implemented. Also, in area of effective risk assessment, where the assessments of the risk were not properly carried out and matrices were not clearly identified, the implementation may not be very, very effective. So it may affect it and give it a challenge.
Okay.
Also, there are some other areas that can make it more issues. Maybe the complexity of the IFC requirement. It can make it difficult to implement or maintain, especially in a large or global organization with diverse operation, multiple locations, and various accounting systems. This complexity can lead to control gap or inconsistencies and inefficiency. So those are the areas we have looked at. Also, in inadequate documentation and testing can lead to poor implementation of the internal control over financial reporting, leading to some control failures or identification. Also, high turnover or lack of continuities, maybe some high, how will I put it now, some employers that are high risk. Maybe when they leave the organization, they can distort the IFRS, the internal control financial reporting process and the implementation. So the knowledge gap also can affect on that. So these are areas that can also the ever-changing regulatory landscape also is an issue. Like the last panelists have also stated that in some area, the regulation change. If technology is not there, you may not be able to cope instantly with this kind of changing the regulatory landscape. Inadequate technology and automation can also, manual process may not help us effectively. Where that depends on the organization and the kind of automation that can be carried out. It may not cover so many, but limitation on manual process will be a good way to implement it. So more often, the technology automation of those processes can help us have an effective internal control over financial reporting.
I think some of the things that you have mentioned, I think they are intertwined because you've mentioned skills, you've mentioned making sure there is a budget. If there's turnover, staff turnover, it can impact the process. And importantly, you mentioned something around getting it right the first time, the risk assessment. You must be able to have ensured that your risk assessment was done correctly, because that would be the foundation on which other activities will be built on. So I'll come back to my my partner, Ibukun. From your own experience, you support organizations, you've been into internal controls for many years. What would you say is the success factor? And do you have any case study? I'm not asking you to mention names, but case study of an organization that did this very effectively so that our participants can learn from the experience that you have from the process.
Yeah, thank you, Bolanle, and thank you for that question. One of the key success factors for a successful implementation of internal control over financial reporting is having a designated team or a project management team. Just like Mr. Moho mentioned, he said lack of timing and poor management. So if as an organization you have not started implementing or the process for implementing internal control over financial reporting or the readiness assessment, is important for you to now start thinking around having a project management office that is going to look at it. Who are those going to be involved in the project management team to help you with the implementation? Because one, you need people who have the experience, who have the understanding or knowledge, and you want to have the right functions to be part of that PMO. You want to look at your financial control team, maybe your financial controller. You may want to consider, depending on the way your organization of the strength of your internal control function, you may want to include them, and also your internal audit. The other bit of it is, do I want to consider a consultant for me to help to support that project so that you will have a particular timeline for doing this? With the team put together, they will be able to set a plan ahead of the implementation deadline. And the first thing is with this group, they're able to look at it from a risk assessment perspective to help understand what is the scoping of the key financial statement line items that might impact or result into financial misstatement. So project planning is very key. And once they identify that and understand that, they're able to document, because one of the key things about internal control over financial reporting is the documentation of the risk, the documentation of the control objective, the documentation of how effective those controls are, or the design of those controls. You want to be able to document it. You also want to be able to state what are the examples or documents that you require to attest. Why is this important? Because if an independent person or your external auditor will want to reperform or give an attestation of your internal control over financial reporting, they will be placing reliance on your documentation. So one thing that is very key is having the right stakeholders in the room in your project management team, to having the documentation, looking at your assurance, your combined assurance team, which is your risk management, your internal audit, your finance control, and also your internal control function, having them to put all of this together and ensure that, yes, all of the key processes that flows into the financial statement line items have been clearly identified. You have documented what the key risks are, what the key financial controls that you have put in place, and you have been able to determine how to test the design and operating effectiveness. Also very important is having a robust tool for you to be able to track, because experience has shown that a number of organizations, they do not have a process or a system for keeping all of their documentation where it is easily retrievable. And like one of the things that Dayo mentioned, he said that technology is something that's going to help you to manage the process because of the complexity involved. So as an organization, you may want to now think of having maybe like a platform or a dashboarding tool for you to be able to monitor and track when these activities do occur. For matured organizations that they've gone ahead to implement internal control over financial reporting, what they've been able to do is to implement a GRC solution that allows them to track, and they've even gone ahead to have their process level involvement, where each of them perform a control self-assessment and they report on it and the file. And they have a file where they can refer to that ICFR file they set aside, so that at any given point in time, they can retrieve those documents and their auditors can test, reperform, or use the same samples or take independent samples to achieve it. So in a nutshell, for key success factors, what we are seeing is having a dedicated team for internal control over financial reporting within the organization. 2, having a project management office where they are able to monitor the process, escalate to the appropriate quarters, because for example, you may have instances where policies are not in place, process documentation are not in place, and this will require the approval for management and the board. So you need the right people who can take decisions to remediate some of these issues, so that within the 90 days of that reporting, those controls are remediated and you can assess them as being effective. Also, you also want to consider the capacity of the team. You may also want to train people and the tools that are available. I hope this will really.
I know you will go on and on if I allow you. Thank you very much, Ibukun, for shedding light on that. I'm sure that a lot of people got at least a starting point for their own journey based on your response. I'll come back to our practitioners, the industry practitioners, just to get their view. I know that every sector has its own peculiar challenges. The challenges in the manufacturing sector are different from those in the oil and gas and are different from banking. And I'm happy that I have panelists from each of those sectors. So maybe I can get your view, maybe starting from Dayo, from a consumer business perspective. What are the peculiar challenges that you have experienced, and how did you resolve them?
It depends on the stage of maturity, but one of the peculiar challenges when we first started adoption was really getting the operational side to own these controls. You understand? So that was the initial challenge, because but once we were able to get that right and have the appropriate governance in place, we were now able to transit from that basic or primitive adaptation to the point where they own the controls. And that's why, as Ibukun mentioned, in Heineken, for instance, they do a business self-assessment. So the business side does an assessment of whether the controls are effective or not. So that was and that allowed them to own that those controls. So for me, that was the challenge that we had at when we first started, and I'm not really referring to the last 1 year. I'm talking about the last 6 or 7 years, if you understand what I mean. So, or when we're able to move from the first level to a more mature level, that challenge was overcome. And of course, we've introduced technology over time to even deepen the process.
Thank you very much. Aliu, from an oil and gas perspective, what do you see?
All right. Thank you, Bolanle. From our own part, we largely operate in the downstream sectors, and then a lot of our activities are operational in nature. And one of the key challenges I think we have when you are trying to migrate from your normal testing of effectiveness for your internal control and then into an ICFR, a lot of the risk and the control assertion that we have are surrounded around operational controls. There were a bit of documentation in terms of design efficiency from our part that we're able to identify that, okay, we have this process in place, we have the risk and we have the control, but we realize that a large part of these risks are more operational, and then we now have to review and then include a lot of financial assertions in the risk and the control as well. If you look at it from the angle, it's one of the questions that I've been bothering everyone around, asking that what is the difference between the normal internal control that we've been having and been testing and from ICFR. And the large question is the major difference is about documentation. Sometimes you might say I have an entity level control where I have to do it through a match and then someone review, someone process. But the question is, did you have this documented appropriately? Did you have it being reviewed from time to time as operational changes? Do you make analysis for effect of change management in terms of that? And do you have necessary resources in place that do this on this? So these are the various challenges that we're able to identify and then we're able to put in place accordingly.
Thank you very much. Monday, from a banking perspective.
Yeah, thank you. Some of these challenges that we face at our initial implementation was actually documentation. So most of the control that we have, most of them, either they were partially documented and has not been reviewed over some period of years. So when we started this journey, we look at those documentations and that have not been reviewed, and a committee was set up which encompasses the several units, financial control unit, internal audit control unit, the internal control, operational risks, to look at all this. So most of them were now look at, okay, each year or 2 years period, all this will be reviewed, an assessment is done, and any update will be done to those areas that have been documentation. So that area was really what affected us, and thank God we have enhanced that, and things that are done are really documented where we can make reference to going forward. And what other area we look at, because of the data nature that is being required, the service of data scientists were engaged, which joined the committee, and most of them will now work with data, not just a sample size, but the data will help us look at it in detail and know those areas that are falling out and why are they so. And some area automation came in. We have a workflow that where an approval is required, maybe where an override is necessary or not, and all those areas were not perfected, and that has also helped us. And the committee meet on monthly basis, that committee reports their findings, their reassessment to its risk management committee, who then now report to the board on quarterly basis. Those areas were able to surmount all those areas, those challenges, and we keep on improving on that due to the changes in the most of these transactions that comes, and also on the regulatory landscape that changes over time. So we look out for that, several policies and CBN regulation that come on board. So we don't joke with it, we pick it up, analyze it, and know what kind of control we can put in place.
I think one of the key things to note from your response is that it is a journey. So ICFR implementation, I think for us in Nigeria, sometimes when we want to implement new frameworks, new standards, we think it's a one-time process. But I think from the comments from all of our industry practitioners, what I can hear clearly is that this is a continuous process. There would be trends, developments that allow you reevaluate where you are and also respond accordingly. So just one last question to Ibukun from my experience and also from the work she has been doing for us at Deloitte. Are there emerging trends, issues on ICFR? You have a broader perspective from working with multiple clients. What do you think are the major trends and that we can lean on?
Yeah, thanks, thanks, Bolanle, for that question. So if you say emerging trends that we can lean on, I think one of the key things that I can see happening is that continuous awareness for within the organization. Because one of the things one of my clients asked me is, I really don't just want to implement internal control over financial reporting. I don't want it to be just a checklist. I want to see the value that is bringing to my organization. So one of the key trends or things that I'm imagining that organizations are asking themselves is, what is this benefit to me as an organization? So one of the things that is very trending about it is they need to capacitate your team for them to know that you getting it right at the first time helps to continue to boost the organization's financials, boost their profitability, and also boost the investors' confidence in the financials. The other bit is the need for technology. I know Dayo alluded to the fact that this process is being complex. So organizations are beginning to see that for them to effectively manage this and sustain the process, there is that need to start having consideration for workflow or technology that can allow them to manage and monitor and provide the right oversight in terms of it. The other thing that we're seeing that most organizations some organizations we've worked with, they currently do not have like a dedicated team now. They are now having dedicated resource who their own role is to man internal control over financial reporting. And the other bit is technology. You cannot overemphasize the need for technology where you are now having to use technology for your documentation, automate processes, and you cannot rule out the fact that the prevalent IT risks, because from experience, some of the things that we are seeing is that you have controls that are both manually and also automated, semi-automated controls. And then you still that those controls, they are fully manual, and you have a system that is generating the numbers. So there is that need for a robust internal information technology system that will allow them to place adequate reliance or even help them to continue to test their internal control over financial reporting. So I would say in summary, one is the continuous assessment of internal control. They need to have dedicated resources. They need to start beefing up your IT security or even information system, putting the right tools in place and having the right person to man those rules. These are key trends that we're seeing. Thank you.
Thank you so much, Ibukun. I have so many questions from our participants. Dr. Durare is doing a good job to help respond to some of them, but I have a few questions I want him to respond on here. And the first is, what would the external auditor require from companies to attest their compliance with the ICFR guideline? And then I'll just ask a follow-on question to say that, what do you think is the responsibility of management for the remediation of any control deficiency that is discovered? Dr. Durare, if you can just help us answer that question from your own experience with this process.
Okay, on the first question, the external auditors first will require the management assessment, which has been done. In most organizations, it will be done by the internal audit department, supporting the board audit committee to do that. So the hand over that to the external auditors. So that will be the starting point for the external auditor. Then the external auditor will now request for the working papers supporting the assessment to confirm that the work that has been documented actually supports the conclusion that was reached on the management assessment. So they will request for your working papers on the entity level controls, what you have done regarding control environment, the risk assessment process, the information and communication, which will be supported by your general IT controls review you have done, then the working papers on the monitoring. Now, with regard to control activities, that will be taken to the process level. So they will need to see all the working papers that has been generated for process level testing. As we all know, you don't test all account balances. It is based on your materiality and your scoping documentation. So your auditors will also request for your materiality and your scoping documentation to be sure that you have scoped in appropriate account balances, which would support their own reliance on your working papers. If at the end of the day, you are not able to provide all this to the external auditors, then it means the external auditor will have to do more work, having to assure themselves that internal controls are in operation. And that will cost you more as an organization because they are going to charge you for cost overrun. Now, with regard to remediation, when there are weaknesses that have been identified, those weaknesses are now evaluated. When they are evaluated and there is need for remediation, then the management are expected to remediate. The good news about ICFR is this: if you remediate before the year end, it will not appear in your report because you have remediated. It will only go as an information to your board audit committee. So if you are not able to remediate, then if it is material, it will end up in your report. Management must ensure that remediation is done, and in doing that, the remediation document must show which department is involved, who is responsible to do the remediation, when will remediation be done, and when it is done, there will be a tracker that management will put in place. And when they have done that, they send it to their external auditors, even before the next audit. They are not expected to wait because the external auditor is expected to review and be sure that the remediation has been appropriately done before year end. This shows that the control environment is strong. If the external auditor come back and remediation is not done, that again is a weakness in internal control on its own.
Thank you very much, sir. I think it's been a very beautiful and insightful panel discussion, and rounding it off with that discussion from Dr. Uwadiae on what is expected when your auditors want to perform their own attestation of the process is a good way to round off the panel discussion. Our panelists are still here. We have time now to look through the questions that you have asked us. For some of the questions that we have not provided response to, I'll be reading them out and be assigning them to our distinguished panelists to help us respond to some of the questions that we have here. There's a question from Tunji, and I think I'll ask Dr. Uwadiae to please help with that question again. Can the chief internal auditor prepare the ICFR on behalf of management for the external auditor to attest as to its reliability and objectivity? So basically, he's asking whether the chief internal auditor can act as management for the purpose of the review process.
Yes, you see, in the governance process, you have the internal auditor there, you have the board audit committee, and the chief internal auditor reports to the board audit committee. So there is independence already. The chief internal auditor does not report to the managing director. So because that reporting line is there, there is independence. So the chief internal auditor does the review. Because remember, this is management assessment. Because it's management assessment, the chief internal auditor will be the party to perform that review. It doesn't necessarily have to be an external consultant. But if the chief internal auditor deems it fit, he could engage external consultant to support as in the form of co-sourcing. You know, Ibukun mentioned co-sourcing. You can do co-sourcing, but the responsibility still falls back to the role of the chief internal auditor. So he does it, then reports to the board. There is independence there. It's not part of, it's different from the CFO. So if the CFO does it, that is where there is no independence. But the CFO is not the one doing it now. The chief internal auditor is not part of the process. He's just in the review line of the process. So it's fine.
Okay, so Dayo, from your own experience, there's a question from Dami Lola. And our question is, in agreeing with the performance materiality threshold with external auditors during the assessment and evaluation of the ICFR program, does this have to be done while doing the ICFR in 2024, knowing the auditors will come for review at year end? Or she's asking the question, what period should be looked at in terms of when you're agreeing?
Your test effectiveness. So they are still going to test. So they also have to have a role, or they have a say in that materiality threshold as well. So it's not something that they just come at the end of the year based on ICFR. They would have done an interim testing, and based on the interim testing, there will be that window for that remediation. So just to explain how it works.
Thank you very much for that response. I hope that answers your question, Damilola. I think the other question that I have here, I think is to Mr. Mo, and it's a question around thresholds. You know, for us, saying that you have to have an annual revenue of 30 billion, or you have 1 billion 1 billion contract from government, 1 billion worth of contract from government. We have several questions around that. At any point in time, when that threshold is, you met the threshold once, but then your subsequent revenue position, you are not meeting the threshold, or you have executed the contract with government. What happens to you in those instances? The participants would like to hear from you on that. Is Dr. Amo still there? Okay, Dr. Juware, would you be able to help with that question then?
Well, that's a very complex question. Yeah, I'll tell you the reason. Because this will still be taken up with the regulator. The threshold was set before the devaluation of the Naira. So that is one aspect. Two, you rightly mentioned, is it a static threshold or a moving threshold? The law on its own is static. So the question as to whether you, as a result of profitability, you drop out, do I stop preparing, will not arise. I will stand corrected by the regulator. The intention and the spirit behind regulation is this. The moment you are caught up by regulation, you don't come out of regulation until you apply to the regulator, and the regulator will discharge you from that process. So for any organization that has been caught up by the regulation by virtue of your turnover or by virtue of any other criteria that was being used, and the regulator has taken you in, if you are to stop, you write the regulator again for a release before you can opt out. If not, if you don't comply, the regulator will pick you.
Thank you very much. Very complex question. And I think that question will keep coming up because when you have threshold sets for regulatory inclusion, what happens when the threshold is no longer met? So it's a complex question, and I hope that you were able to get some perspective from that from Dr. Uwadiae. There's another question, and I think this question is to Aliu. Someone is asking about the ICFR implementation, and he's saying that, do you not have to look at all line items in the trial balance? Are you only to focus on the volume, complexity, and risk level, or you're going to be looking at evaluating every line item in your financial statement? Temitope and Jory asked that question.
All right, thank you, Bolanle, and thank you, Tebo, for the question. As being said from all the speakers and the panelists saying, when you're doing your ICFR implementation, your scoping and the determination of the maturity threshold is very important. You also agree with me, even audit itself sometimes it's more like a sampling. So you don't have to text all the transaction, because you look at it that this is your activities from your organization. You want to look at transactions or balances, how important are they, and what contribution do they have to your financial statement at the end of the period. So it varies according to organization and what you have in terms of transactions. So I mentioned those factors when I was talking about the risk assessment, because in defining your risk, more like setting up your risk profile, you want to look at where are the areas you want to focus. And that's why those factors come in and say, I want to look at nature of transaction in terms of their complexity and the judgments that were driven the balances. So if the organization is very medium organization that you want to look at and say that a 50,000, a 10,000, I don't want to be specific in that, is important as material organization, then you should develop appropriate risk framework around it.
Thank you very much. And I think the last question we can accommodate for this session is the one from, I'll quickly take Kemi Ashaulu. You asked us so many questions, but I'll take the key ones that I know we haven't covered. Ibukun, if you would help me, please. She's asking, when there are data limitations, what would happen? Are we going to say that we can't certify the internal controls? And then she's asking also that what really is the difference between test of controls and substantive procedures? To what extent do we perform substantive when testing ICFR? I think those two questions, if you can quickly answer them in 1-2 minutes, I would appreciate. Thank you.
All right, thanks, Bolanle. Our first question is on that availability of data and its impacts on the attestation. One of the principles that I really hold there is what is not documented is not done. So if a client or your organization doesn't have the data to provide to substantiate how they have performed the control, it's going to be very difficult for you to really attest to the design of the control or even test the operating effectiveness. And to the second question around how would you test the operating effectiveness, or what's the difference between the test of the substantive testing? I think the test of operating effectiveness and substantive testing, they are very, very similar. And why did I say that? Because if you're doing your substantive testing from an audit perspective, you're looking at a number more samples. in that regard. But for test of operating effectiveness, you want to use a sample guideline depending on the frequency of the activity. And that is why the internal control over financial reporting, and even as the regulator has put it, that test of operating effectiveness is only providing reasonable assurance because, one, you are looking at it on a sample basis for you to gain assurance, but from a substantive testing, you're looking at a whole number of sample testing, which your external auditors will look at their audit methodology in performing the test of procedures that they will use depending on the significance of that account, and it will determine the samples they will select, and they have a certain methodology around it. Well, for the test of operating effectiveness, for example, if I have a monthly control, then I'm going to select like 12 samples for me to test and confirm that yes, it is operating. Or if I have activities that are beyond monthly, maybe I'm going to do like 25 samples to select. So I think that I hope that assists you in arriving at your conclusion. But what is not documented is not done. Non-availability of data for you to perform your review ordinarily tells you that there's something you need to look out for. Is a red flag. I can hear anyone speaking. Is Bolanle still there?
I think she's just come back.
Very much. Sorry, thank you. I had a brief network. Thank you very much. It's a good way to round off the session. And I think we've had a very beautiful and informative session. Thank you so much, panelists, for doing justice to this topic. For our participants, please, for the questions we were not able to respond to, we will do our best to respond to them and also send you the presentation that was made today. I would like to call on one of our senior partners, the leader of our consumer business audit, to give a closing remark and to thank participants for being here. Thanks so much, everyone.
Okay, good afternoon, everyone. My job is quite simple. It's just to tell you thank you. Distinguished guests, esteemed colleagues and friends, on behalf of Deloitte Nigeria, I want to appreciate your presence at this webinar. I guess we've all had a very wonderful time here today. I want to say a profound thank you to the representative of the FRC, Mr. Uwadiae, for delivering the second keynote address today. And I want to thank you for the stimulating session and for the clarification on the expectations of the FRC from non-listed entities on the implementation of internal control over financial reporting. Specifically, I would thank you for pinpointing what benefits ICFR can offer organizations, the roles of relevant stakeholders, and how to avoid FRC sanctions on ICFR. Because I can see a lot of questions came around sanctions. And we are very glad, and we believe that the participants are happy to hear some of the things you said about all that. I also express my gratitude to my colleague, my senior colleague, Dr. Uwadiae, for the well-delivered keynote address. Thank you for breaking it down so well and so clearly as usual. To the panelists, Ibukun Bicroft, Deloitte partner, thank you very much for your insights. Uwadiae of Nigerian Breweries, we appreciate you. Aliu Camillo of Itana, thank you very much. And Monday Okogu from SCMB, you have all taken your time to honor this invitation, and especially in providing valuable insights on the ICFR journey in their respective organizations, as well as sharing useful and relevant experiences. Again, thank you for responding to the questions and providing necessary clarifications in all areas of complexities raised. Thank you all for your time. Finally, the technical team has successfully put all of this together and treating us to a very rewarding and impactful section. We thank you all. I hope we are better informed and equipped with more holistic knowledge about the expectation of the FRC on ICFR for non-listed public entities in Nigeria. I feel I should also reiterate that as a firm, we are here to support you through the ICFR implementation journey and provide guidance in complying with the requirements of the FRC as it relates to the implementation. We at Deloitte look forward to collaborating with you on these integrated audits in the coming months. Thank you all and enjoy the rest of the day. Bye-bye.
Bye.
Thank you very much.
Thank
Bye,
you.
everyone.
Yeah,
Bye.
bye. Yeah, thanks. Oh, a good one.
Yeah. Excellent.